The principle of no offsetting in accounting, clarity in financial reporting. In the world of accounting, the principle of no offsetting is a guardian of clear and truthful financial reporting. The no offsetting principle in accounting dictates that financial elements such as assets, liabilities, income, and expenses should not be combined or merged into a single consolidated figure in financial statements. Instead, they must be presented distinctly and separately to provide clear and unambiguous financial information. This principle ensures transparency, accountability, and comparability in financial reporting. In this session, we will elucidate the no offsetting principle, discuss its significance, and provide practical examples to illuminate its role in ensuring precise and transparent financial statements. The relevance of the no offsetting principle. The no offsetting principle holds great relevance for the following reasons. Transparency. By disallowing offsetting, this principle guarantees that financial statements remain transparent. Users can easily discern and evaluate each financial element without any confusion or distortion. Accountability. The no offsetting principle promotes accountability by preventing businesses from masking unfavorable financial aspects through the combination of opposing items. It compels businesses to honestly disclose their true financial conditions. Comparability. In the absence of offsetting, the financial statements become more comparable, enabling straightforward comparisons over time and with other businesses. Users can have confidence that the figures presented are not manipulated for convenience. So now let's explore the practical application of the no offsetting principle. The no offsetting principle is manifested in various aspects in financial reporting. Asset and liability distinction. Businesses are mandated to exhibit their assets and liabilities separately in the balance sheet. For instance, if a business holds a positive cash balance in one bank account and a bank overdraft in another, these must be reported as individual line items. Income and expense separation. In the income statement, businesses are obligated to report their income and expenses separately. This means they cannot merge a substantial source of income with a significant expense to present their financial performance in a more favorable light. In conclusion, the no offsetting principle in accounting is a cornerstone of reliable financial reporting. By barring the practice of offsetting, it ensures that financial statements maintain precision, transparency, and accountability. This precision and reliability serves as the bedrock for informed decision-making by stakeholders and fosters trust in the financial information. In a world where financial transparency is paramount, the no offsetting principle plays a crucial role in preserving the integrity of accounting practices.